Hi, I'm Jenny Brown. Welcome to this week's MFB news. I hope you're keeping really well and that the various storms that we've had over the last few days have been kind to you. We're really lucky actually. We got off pretty lightly, a few roof tiles off, some fence panels took a pasting, but largely we were fine, and I hope the same can be said for you. Now, in terms of what we got for you this week, we have got some pricing changes from lenders. There's a whole swathe of upward pricing happened in the last week. We've also got a couple of bits of good news in terms of rates that have been introduced. We're also going to cover off this week what actually is income, or regarded as your income when you're applying for a buy-to-let mortgage. It's not as straightforward as you'd be forgiven for thinking, so we're going to go through that. And then we're going to talk a bit more about what's going on in the housing market currently. There's definitely signs that transactions have slowed down. We'll go into a bit more about what that actually means, why that might be. And then lastly, we're just going to cover off briefly the latest news which impacts how properties can be advertised or have to be advertised when they are for sale. Okay, so we're going to kick this off with some positive news. Capital Home Loans have made a series of changes. So first of all, what they've done is they've introduced a range of 7-year fixed rates which start from 3.25%. And the reason I say they start from is they have different 7-year fixed rates depending on the loan to value and also the property class, so standard and HMO as well. But look, if you can fix for 7 years at from 3.25, actually that's quite attractive, particularly in the more specialist end of the market, so limited companies, people with really large portfolios. So the benefits of a 7-year fixed rate are obviously that you're just elongating the period of time that your rate is guaranteed for, which really just gives you real peace of mind and certainty of payment, and also protects you from interest rate increases. The downside obviously is that you are committed to the mortgage, financially committed to the mortgage for a period of 7 years. And some landlords seem to find that actually 5 years is really as long as they're willing to commit to things for, either because they may want the ability to sell the property, they may want to refinance, raise extra money from their asset as well. But look, some people actually, and we're definitely seeing a change in mindset on this. I think when interest rates start to climb, people's perspective on what's important to them starts to shift, which is understandable. And so actually locking in for as long as possible becomes quite attractive. So what we've seen in mortgages for business most recently in the environment that we're in, which is interest rates increasing, is that more people are currently asking for those longer fixed rates, so 5, 7 and even 10 years as well. Now, the other thing that Capital Home Loans have done is introduced 80% lending into their product set. So they have a series of products, 2, 5 and 7 year fixed rates at 80% loan to value, and these now start from 3.49%. Is that really competitive? Well, look, in the personal sort of vanilla high street end of the market, you can get rates starting from more like 2.8% to 80% loan to value. But in the specialist end of the market, so limited company lending, people with really large portfolios, that kind of stuff, actually the pricing sits very, very competitively. Now, in terms of the 80% lending, there are a few kind of points to note in terms of their criteria that sits around the 80% loan to value piece. So first of all, the maximum loan size at this level is £500,000 on any single property. The next thing they're saying is that for any one borrower, they will give 80% lending up to an aggregate debt, so all of the various mortgages they would have to that one particular borrower, at no more than 80% loan to value. But they can lend up to £5 million so the next 2 to 5 million would be at 75% loan to value. Now, they're also saying that 80% loan to value is only available against standard freehold and leasehold properties. So any construction type that's highlighted by their valuer as being non-standard would be capped at 75% loan to value. Additionally, anything that is any properties that's above or adjacent to commercial property, they're capping at 75% loan to value. And lastly, HMOs and multi-units are 75% loan to value. So the 80% piece is really there just for those very, very standard properties. Why is that? I guess really the properties which are non-standard are harder to sell on, or can be harder to sell on, and are seen as higher risk. And therefore more kind of open to price or value reductions if the market turns. So that's why they're kind of hedging themselves there and just managing risk levels a bit. So briefly, Capital Home Loans, they're happy to lend to individuals and limited companies. I guess I've made that quite apparent. They have a product set which is available for SPVs and also trading companies as well, which is quite important. They're able to take a view on layered companies, so a company owned by people, which we're seeing becoming increasingly popular as a kind of structure. This all links into moving deposit monies into the borrowing entity. If a company is owned by another company, so you have a trading company which has got a load of cash in it, you want to set up a new SPV company to go out and do your buy-to-let investing, then actually the way the accountants tend to prefer you to structure this is that the new co is 100% owned by the trading business, and you can move the money from one company to another via intercompany loans without there being any taxation to pay. So a really solid offering, and actually it's really nice to see Capital Home Loans bringing out something positive to share with you, because in a moment we're going to move on to the pricing increases over the last week, which probably doesn't make quite such pretty reading, I'm afraid. Now briefly, an interesting thing that was announced this week, Paragon are allowing existing borrowers to secure a new rate with them via their product transfer offering up to 6 months in advance of their existing mortgage deal ending. So what this would mean is that if you had a mortgage with Paragon, your rate finished on the 31st of December 2022, then in theory on the 1st of July you could contact them and lock in and secure a new deal with them for the end of the year. Now the benefits here will obviously be that with the prediction that interest rates are just going to keep going up over the course of the year, the earlier you lock in a new deal, the better it's going to be for you. And 6 months is an incredibly generous window of time when it comes to product transfers. So to give you an idea on this, some lenders will only let you product transfer 4 weeks before your existing deal ends. Others will give you up to 3 months, but 6 months is really kind of bucking the trend here. So if you are a Paragon borrower and you are thinking about transferring your product with them, do give us a call and we can run through how that would work and the options that are available. But like I say, so they're real outliers in terms of their approach here, and I think it's one to be commended, and I really do hope that other lenders choose to follow suit. Now, Skipton announced in the last week that they are changing their view on what is classed as income when you're applying for a buy-to-let mortgage. So what they used to do is say we have a minimum income of £25,000 a year. That income cannot be derived from rental income. So essentially, you would have to have a day job or pension income or something else, but they would not accept your rental profit as income. Now, this just got me thinking that actually this is quite an interesting thing. So what Skipton have done, I should really just hasten to add, is that they've now made the move to say that actually we will use 100% of rental profit towards our income requirement. So if all of your income is from rental income, that's no problem with us. We'll accept that in terms of meeting our minimum income threshold for applying for a buy-to-let mortgage. So the reason this is interesting, I suppose, is really it just highlights or maybe refresh my memory that actually not every lender accepts rental income as income, and actually what is income? And this is where it gets quite convoluted. So some lenders will say, look, as long as we can see that you have £25,000 or whatever the magic number they're looking for is, it doesn't matter where it comes from, as long as we can see this as a bona fide source of income. And generally they'll look to verify this either by pay slips and P60s or tax returns, we're happy to lend. Some lenders will preclude rental income from that. Other lenders exclude pension income, particularly state pension income, which is crazy because obviously it's like the most guaranteed form of income that there is, but some lenders do not accept it. Likewise, some lenders will include things like working family tax credits and child benefits. Other lenders will not. And the other one that's quite interesting as well is for company directors. When lenders are looking at income, and this actually extends into the world of residential homeowner mortgages as well. Some lenders will say, look, if you're a company director and you're drawing money, you own your business as your business, then we will class your income as being whatever you are drawing as salary plus whatever you have taken as dividends. Other lenders say, well, actually, we understand that as your business has made a bunch of money which you haven't drawn out, you've left it in the company as a retained profit. And we understand that you could have drawn that money out, but you have simply opted to leave it in the business because that's more tax efficient for you to do so. We're going to actually accept your share of the net profit as your income rather than your dividend payment, which is the amount you actually drew out. So some lenders work on salary plus share of net profit. Other lenders work on salary and dividends when they're looking at actually how much do you earn. So like I said, I just thought it was quite an interesting one. And part of the role of a broker, obviously, is when someone comes to us looking for a mortgage and, we're trying to match them up to an appropriate lender, making sure that the lender that we're going to approach matches their kind of income structure and sources is a really key part of that. So yeah, one I thought I'd just share with you this week. Okay, now as I mentioned, there has been an absolute swathe of rate increases in the last week, and I won't go through them in too much detail because, quite frankly, I don't think it's that, stimulating to listen to. But top marks go to the Coventry, who have made the largest increases. So they have increased their rates by up to 60 basis points, 0.6%. So as well as the Coventry, we have seen, wait for it, rate increases from Platform Home Loans, Principality, and that's across both their buy-to-let range and their holiday let range. We've seen BM Solutions make increases on their remortgage and let to buy range. Zephyr Home Loans have increased all of their rates bar their multi-unit and HMO products. We have seen Foundation Home Loans withdraw 26 of their products, and the ones that are remaining have been increased as well. So a little flurry of activity there in terms of lender pricing. Now we've also seen the Skipton reintroduce their 5-year fixed rates. So they pulled them last week or the week before, and they hadn't brought any 5-year fixed rates back on at that point. They have now done so. These have been reinstated, but they are now 50 basis points, 0.5% higher than they were before the removal. Now, the Leeds have also withdrawn a load of their products and haven't currently replaced them. All of their other rates have been increased by up to 0.38%. And lastly, Accord Mortgages have withdrawn 21 of their products, which they have not yet replaced. Now, when lenders are withdrawing products and not replacing them, generally speaking, this doesn't mean they have no plans to replace them. It's just they simply haven't prepared the products, they haven't got their pricing structure, they haven't secured the kind of costings on those rates in the background, so they haven't got them ready in time, essentially. So when we're saying that lenders are pulling loads and loads of products, it's not that they're kind of stepping away from the market or anything like that. It's generally that the pricing isn't simply ready to go at that moment in time. So yeah, busy week on rate increases over the last 7 days. Okay, now in the last couple of days there has been an announcement that there's going to be new compulsory information which is really designed to help home movers and home buyers make informed and educated decisions, I guess, about properties which they want to buy. And these changes, or the first round of changes I should say, need to be implemented by the end of May this year. So essentially what this means is that when a property is advertised for sale, certain information has to be disclosed on the property listing. And under the first phase of changes, this is going to include the property's council tax band or rate, the property price, and also tenure information as well, so whether it's freehold or leasehold. Now, like I said, there's going to be 3 phases of changes brought in, and this is part of a project which is being run by the National Trading Standards Estate and Letting Agency team. And really what it's going to do is really just drive up the quality of information that is being made available to prospective buyers up front, with the view that hopefully any kind of issues are headed off at the fore, making the sales buying process slicker and saving people money from aborted transactions where things come out later down the line. So what they're expecting to introduce over further 2 phases are going to be things which are kind of classed as relevant information, which include restrictive covenants which are attached to the property, flood risks, and any other certain specific factors that may impact that property itself. So look, I think this is actually really good news. It's been championed, like I say, by estate agencies. They're really, really happy about this. So I think this can only be a positive thing. And obviously, if you're investing in a property, the more information that you're armed with up front, the better it's going to be for everybody. And lastly for this week, house purchase activity has slowed down. So the number of UK residential property transactions totaled 85,520 in January of this year, which is 12.6% lower than January 2021 and 22.2% lower than in December of last year. And this is according to the latest data released by HMRC. Now, I think anything that kind of shows the slowing down of property transactions kind of is quite headline grabbing, particularly after, the last year and the kind of activity that we've seen in the market. And I think people will be very quick to kind of jump on this and get all excited and say, the housing market is slowing down, things are going to fall off a cliff and all that kind of stuff. But actually, when you dig into the information and the kind of commentary that sits around this, actually it's not the housing market slowing down in terms of a lack of people wanting to buy. Actually, what has happened is that it's a kind of fallout of the lack of stock available on the market. So there are very few properties for sale at the moment. Anyone who's been looking to buy a property over the last 6 months at least will have kind of recognised that the number of available properties to buy is very, very small, and therefore when something does come on the market, there's a huge amount of competition for it, which in turn means that it sells relatively quickly, and actually the price of it holds firm and even sells for more than maybe one would have been forgiven for thinking it would have done. So actually this lack of activity is driving up house prices rather than showing that they're going to start slowing down. Now, a gentleman called Jeremy Leaf, who is an estate agent and former RICS chairman, has commented that rapidly rising asking prices are one thing, but transactions are quite another, and always a better measure of property market health. And what these numbers are showing is really the continuing lack of stock, which is constraining activity and only supporting the acceleration in prices. Now, what he goes on to comment is that the good news is that listings are on the up, prompted by the increase in energy price and interest rates. This should help to better balance supply and demand, as well as keep prices in check. So really what Jeremy, I think, is saying here is that actually when we see more properties come to the market, that will drive up the supply, that will then slow down the competition and therefore keep property prices from going too crazy in 2022. And that's it for this week. Thank you for joining me. If you do have any questions, we would love to hear from you. 0345 345 6788. Have a look at our website, mortgagesforbusiness.co.uk. Look, I can't reiterate this enough. Mortgage rates are going up. If you are in the market for a mortgage in the next up to 6, really 7 months, please do give us a call. We can certainly do something to help lock you in a deal now and really secure you a rate at today's prices rather than those in 3 or 6 months' time, which are going to look, much higher. But in the meantime, look, let's wish for some better weather. Let's hope we have a good weekend with some bright sunny skies, and I will catch you all again the same time next week. Look after yourselves until then.